Recording is recording. Okay. So welcome to the Beginner Small Account Trading Group for Thursday, June 28th, 2018. Disclosure is that Aeromir, Capital Discussions, and myself, none of us are a broker-dealer or securities investment advisor. And so everything that you see and hear here is for educational purposes only. Options involve risks, and you always trade at your own risk. We don't make any specific trade recommendations. And past performance not indicative of future results, and you can pause the recording and read all the fine print if you'd like to. Okay, so I did that. Now, let's see. A few more people. Tim Broth, welcome. Peter, Oshi Boonen, M. Woodson, okay. And Craig, thanks for joining in. We have 9 people here now. I have 1, 2, maybe 3 small subjects to talk about today. And then maybe if there's any questions, we can talk about questions or concerns or things that you're thinking about as well. So I'll go ahead and dive right in. The first thing is I have taken some action on 2 of my covered calls / cash secured put trades, and I'll show you those real briefly just so you see what I've done and why. Second, I want to use oil. Well, you may know I'm trading oil a little bit, and I've got one that's gone against me, but I want to use Thinkorswim to show you how you can figure out when it might become profitable. And then I want to talk a little bit about how you can hedge or neutralize Vega on a road trip style trade while not letting your delta get out of control. In other words, how to neutralize or manage both of them with a couple of different methods. It's useful, I think, because number one, you may do that on some of your trades, or you may want to someday, and so to know how to do it would be good. Number two, it shows how you can use, it'll show how you can use Thinkorswim to make things easy for you, and so it'd be good exercise in what you can use Thinkorswim for. Okay, so let me dive right in. Let's start with the covered calls. I can bring up my little spreadsheet here. I decided to re-enter QCOM since last week, and that's this trade here, and I'm running them all together in one spreadsheet here so we can see what our grand total turns out to be. But the facts are, I did most of them in one account, and I did this one last week in a different account, but I am running them all together, so no problems with that. The cash secured puts do exist in just one account. So on June 22nd, which was, I think, last Friday, when QCOM was at 58.90, I sold cash secured puts, August 55 strike for $1.27. So if we go look at QCOM now and see how we're doing, and I bring up the August series, the 55 puts are here. They're currently quoting at 230 by 242, and QCOM is at 55.90. Okay, hasn't gone in the money yet, but it has gone down towards the money, so these are going to be a loss on paper at this point. 230, we sold them for $1.27. So if I wanted to exit, I could close this trade. I could buy back those 2 puts for $230 each, and it cost me $450, $460. I'd still come out with about $600 profit. But I'm not ready to do that. We're going to just stay in this trade and see if they waste away some more, and I can get closer to this net here. And of course, 17 August is only 2 months away, or a month and a half, and if it goes below 55, then I can roll out and down, out in time and down in strike, and probably for a credit, and keep this trade going. So I'm not worried about it. We just need to wait and watch it a little bit. Okay, the other one is Duke, and We've been doing Duke since, I don't know, back in January. Now, it was at 83 when I opened it. It went clear down to 72.15. And in so doing, I had rolled the strikes down and out. You can see it went out as far as October, and I went down as low as the 77.50 strike. I got a lot of credit for it because it was in the money when I did it. And Duke has been nice enough to recover a lot. So last week, after our session, when we looked at it, I did decide to roll it in. I didn't change the strike, but I rolled it in closer so that it'll expire sooner and I can start a new one sooner. I did that for slight loss. Well, not so slight. It was about 60 cents, 50, 60 cents, 58 cents, something like that, which means before I did this, I had about this much potential profit in the trade. And now because I paid 50 cents times 2, I have about $100 less, and that's exactly what it's showing. So if these expire, that'll be my profit on this deal since December. And I'll probably continue to do them just to keep working Duke. Having said all that, though, you know that Duke is not a very good stock for doing cash secured puts on because it has 5-point strikes or 2.5-point strikes. And you'd ideally like something with 1-point strikes. It'll make it a little bit easier to roll up or down or whatever you're doing. Also, you would like to have lots of expirations, and they don't have weeklies on Duke. So this is not a good choice for doing cash secured puts or covered calls on. However, I like this stock, and I wouldn't mind owning it. So that's why I did it. Okay, so that's the update on those. The rest of the positions they're still open. They haven't changed. I haven't touched them since last week, and so we'll just let them continue to cook. And notable, I have positions on Altria Group, MO, right here, you can see it. It's going up, which is kind of nice because these are covered call positions, and it's still below where I bought the stock at, but it has been as low as 55 or 54 or something recently. It's nice to see it coming back a little bit. And today was a big move for Altria. Same with Philip Morris. Today was a big move on Philip Morris. I don't know why. I don't know if there's news or anything. I don't know this little thing. I think it needs earnings. So I don't see any news items on either of those, but there must be something happening with the tobacco industry. Philip Morris bought the shares for $79.91 and sold the calls for 67 cents at the 85 strike. So it being in the 80 range, 81 range right now, I mean, it couldn't be more perfect. It's higher than when I bought it, and it's less than the strike price of the calls. And this is a stock I want to keep and get dividends on, and so that trade's going well. Okay, so that's it for those positions and campaigns. Let me shift gears here. And let's talk about oil for just a second. Not because I want to teach you how to do oil, because I don't know. I'm doing it, but I have a lot to learn too. However, in the August expiration, I've traded in and out of it several times. And here, I'll just bring up my simulation. I can show you that. And all these trades have resulted in a profit of $350. However, I made another trade, and I almost wish I hadn't, but I did. I decided to re-enter and sell some calls at the 76.50 strike, which is right here. And I sold one. I only did one contract because I didn't want to go too far. And I sold it for 24 cents. Okay. And you just saw it's quoting at 59 by 61. So this has gone against me by 36 cents, which is $360 on oil. So if I closed it right now for 60 cents, I would give back all that profit and essentially be zero for the month. But I'm not ready to do that. I am ready to roll it up and out if I have to, but right now we're waiting. So here's the question. Let me take out all these other trades for just a second so we can look at just this last one that's got problems. And we look at the graph, and the question is, let me clean up that graph. At the current price, how much time has to pass before I can close this for break even? Or maybe even a little profit. You can estimate that from the graph, and that's what I want to show you how to do. There's two ways to do it, but you have to think it through. So since I'd like to sell this or buy this back for 17 cents, at which time I will have made 7 cents on it, or $70. What I'd like to find out is, at the current price, when can I do that? When will it quote at 17 cents, and when can I buy it back for that? Well, probably the easiest way to do it would be to say, don't worry about what I paid for it, but let's look at right now. If I sold it right now for 59 cents, I want to know when I can buy it back for 17 cents. Well, 59 minus 0.17 is 30, I don't know. I'm really getting bad about math in my head. 33. So I want to know when it has gone down by 33 cents. Which means, since I sold this, that means if it goes down by 33, when it goes, as the price of this goes down, I'll be making profit. So I really want to know, when am I $330 profit from here? Does that make sense? I want to know on what day will this show $330 profit? Because if it did that, it means I'd be buying it back for 17 cents. So we'll just start running the date forward, and we're going to watch the T+0 line, not the expiration line here, and we're going to look for a profit of $330. Next day it's 248. We'll just keep going a few more days. Now it is 348. Go back one day. 309. So what's going to happen somewhere between July 7th and July 8th, according to the model, and at the current price of oil, which, you know, it won't be there. But I'm just trying to see how much time must have to go by before I might make the profit I want on this particular option. Okay, so that's one way to do it. Another way to do it would be simulate buying it, and as the price goes down, it'll go against me. And I want to know when it has gone against me by $330. And it's the same idea. We'll just crank this up until the T+0 shows about $330, and I should get the same answer July 7th or 8th. Okay. So that can be useful when you're trying to figure out, you've done a credit spread on butterfly trade or something. That can be useful when you're trying to figure out when you might be able to harvest it at the current price, or even another price. Let's say you want to know when you can harvest it for break even or some small profit if the underlying went down, you know, from 73 to 71. It'll happen sooner, right? Because it's going down and that's in our favor. So let's just go back in time until we see $330 here. A few more. Approximately here, so approximately yesterday. In other words, if this went down to 71 right now, we'd be able to get out of it for 17 cents and close this trade. Okay, so you might play with that and see if you can see how that works. And it's a little trick you can use when you're trying to figure out higher credit spreads might turn out, or your unsecured options. Okay. All right. Let's shift gears now into this butterfly example. Well, we've got 12 people here. That's good. Chris, thanks. Good to see you again. Ron, Pa, I thank you for joining. Peter, okay. I hope I'm saying the names right. Here is, let's see. Let me make sure I have what I think I have in there. I made this little example. Yes. So this is a piece of a road trip that I actually have on. It's a live trade for me. You're not seeing everything that I've done. You're simply seeing the opening. And I opened this on, let's see if I can tell you when I opened it. This one I opened on oh, there it is. June 12th. I opened this one on June 12th, and this is the price that I got for it. So that's how this trade started out. Now, here we are, June 27th, and let's say that you want to neutralize your Vega, take any volatility risk out, at least as of the current price. But you have to do it in such a way that you don't get your delta out of control. I mean, you can't get negative 100 delta or positive 100 delta. So there's two variables that you need to manage as you do this. And there's a couple of different ways that come to mind to do it, and I want to show you that here as an example of how you can do this kind of thing. But before I start, as somebody pointed out to me recently, Thinkorswim has some cool things on these graphs besides just P&L. If you come up here to the metric, P&L open, change this to Vega. Now what you're seeing is a graph of what your Vega will be at expiration, which is 0 because it has to be, and as of the current day, T plus 0 versus the underlying price. So you can see that right now our Vega is minus 1,015, and we saw that here in the price slice. But if market goes down to 2,700, our Vega is predicted to be minus 1,100. So we have a negative sloping Vega as the market goes down here, which is actually not the way you want if you don't want to get hurt by Vega. If you had an upward sloping line, that means that your Vega would be more and more positive as the market goes down, which is great because then you'd have more than hedged off all your Vega risk. But these trades that are high theta and income style trades typically will look like this, where they have a negative sloping Vega graph. Same thing, market goes up, Vega will decrease. That's also a function of the model that it's using, and things can change, but that's a function of the model too. So you can do this for any complicated position you have. You can look at this and see what your Vega is going to be. Likewise, you can look at delta and you can say, well, if the market goes down to 2680, my delta might be positive 64. You see that right here. Okay, and we know that it's going to be worse than that because of gamma effect, and I don't think this model is trying to take into account gamma, plus it couldn't because it doesn't know what it's going to be. So you could expect it to be a bit worse than that. But important to note that you can get a model prediction of your Greeks by changing this metric here in the Thinkorswim graph. Typically with road trips, market goes down, delta goes up. Market goes up, delta goes down. It's just how it works in going against you. So I didn't mean to dwell on delta, but you have all these other metrics, so you can see what your gamma is predicted to do as the market moves. You can see what your theta is predicted to do as the market moves, which is basically our t = 0 graph. This is not taking into account time. You would have to change the time frame here to see it on a different date. And rho, nobody really cares about rho very much, but if you did, that's what it would look like. Rho is a measure of interest rates, and we don't worry about it too much in our trade. Okay, so I diverge a little bit, but now, next question. If you're going to neutralize Vega, then the fundamental piece of knowledge that you need to know and should know is which options have high Vega. And the answer is it's the at-the-money ones and the further out in time ones have highest Vega. So the further out in time you go, the Vega increases. The further, the closer you get to at-the-money, the Vega increases. Now that's good fundamental knowledge, just like fundamental knowledge of which options have high delta and which have low delta. I suggest you commit that to memory and keep that in mind. But Thinkorswim does a good job of showing us this if you don't remember it, and if it ever updates the screen, I'll show you. There we go. Now we go down to this product depth thing, which is at the bottom of the options chain in Thinkorswim. Come in here and select options. You can say puts or calls or both, or out of the money, average. You have all these different metrics that you can graph. You can graph all possible series that are out there, which we'll leave it there for a minute. Oops. No, I did it. Oh, yeah. And then come over here and be sure and select the metric that you want to measure. And just like before, it'll measure a bunch of different metrics that you can see the effect of. Extrinsic is a good one. And applied volatility. This is where you can see the volatility skew graph in Thinkorswim. Applied volatility. Okay, well today we're interested in Vega. So let's go select Vega. There it is. And you can see right away SPX is at 27.16 right now. It's a really fine graph, and I don't know if you can scale it or not, but that's approximately right here. And you can see in all series, these are the options where the peak, almost the peak of the graph is, and these are the ones with the highest Vega. Okay, now it tilts a little bit the more in time you go out, but an out of the money put, for example, is going to have lower Vega, and an in the money put is going to have lower Vega. So this is the answer to that question. This graph, you should kind of have a mental picture of it or something. It'll help you out sometimes in your trading. All right, so what this tells me is if we want to neutralize our Vega, then we want to buy options that are either at the money or further out in time, or both. That's the best way to get Vega. Well, if I come back into the series, let's look at the September 1 month out in time at the money. It is right here, and let me change it so we can see Vega in our column list here. I'm going to take out some of this stuff, and how about take out last, and we'll put Vega in. Okay, you can just scan the columns and see that it's the at the money ones that have the highest Vega, right? It goes down above and below it. That's another way to see it. So if I buy one of these puts, let's say the 2720, you can see that it makes a huge difference on my Vega. It was negative 1,023, and one put pretty much cuts it in half. All right, but look what has happened to our delta. It was positive 36, and now it's negative 11. We've got quite a large swing in our delta, which might not be desirable. So if you think about delta for just a minute, puts have negative delta, negative 0.47 for that one. Calls have positive delta, positive 0.53 here. So if you, let's say you bought a put and you bought a call, maybe you could have almost no delta effect and a tremendous Vega effect. So let me simulate that. Let's just buy one of these calls. Now you can see that our delta is pretty close to where we started, which was positive 36, yet our Vega is almost 0. And this is my whole point. This is where I'm going. By some combination of puts and calls, you will be able to find a way to neutralize your Vega and not affect your delta. Now, before you say, okay, I'm going to go do that, you have to think about, is this going to fit in with your trade or not? This might blow the trade, but you can neutralize your Vega and your delta. If we took a look here, the problem is that these all have negative theta, which means your theta is going to be greatly diminished. Without it, it was 113, and with these, it's as low as 30. That might make it so the trade cannot be profitable. But if you strive to find some balance point, you know, where maybe your theta doesn't hurt too much and your Vega is, let's say, cut in half without affecting your delta, maybe that's the right thing to do. It would take a lot of back testing to know exactly what the best or right thing is for you to do. But I'm pointing out that it can be done, and this is a possibility. All right. So does that make sense before I move on a little bit? I want to be sure I explain that right. Anybody have any questions about that? Okay. Let's uncheck these two for just a minute. Oh, I have something. Let's see. Seems clear. Thanks, Gary. Thanks. And by the way, Gary, I'm really happy. I'm really proud and happy to have you here. You're a good guy, and you do great work. Okay. As far as positive Vega trades go, what comes to mind? Do you know of a trade that has positive Vega? And the answer is there are two. Calendars typically have positive Vega, and diagonals can have positive Vega, or they can have negative Vega. Yes, Nathan, you're right, calendars. Depending on how you structure a diagonal, it can be positive or negative Vega. So can we do a calendar that can accomplish the same effect as we did with individual calls and puts? Well, let's figure that out. So let's just say we're going to buy a calendar at the money. Oops, I have to do this. Sorry, I have to go back to August. And scroll down to the at the money and buy calendar. Thinkorswim, something has changed. It used to be when I did exactly what I did, it came right up here and said calendar. And it looks like it's initially assuming that it doesn't know what I want to do. But I do know that if I, because this, it has assumed in that template that we're using the same series, and I'm not. So you have to come in here and fix your series when you do that, and we'll just move this one out to September. Now, if you come over here and click on custom, you can say, it says, oh, you could be doing a calendar, and I'll just change that to calendar. It doesn't matter, as long as you get your strikes and your series correct, it'll still work. But Thinkorswim used to behave differently on that. Something changed a little while ago. So know what we're doing here. We're buying a September at the money put, which is going to have the highest, well, going to have high vega. And we're selling in August at the money put, which is going to have lower vega. So we get our positive vega that way. Delta, there will be a delta effect, but it should be pretty low because both of these are at the money. It'll be approximately 50 delta. And you can see the August one is at 48 delta. And the September one is going to be about 49, maybe. Let's see. 47. Okay, I went the wrong way. 47. But they're really close. And Thinkorswim shows that right here. The net delta effect of this calendar is positive 1.08 delta. All right. Well, so what have we done? With the one lot, we're starting to reduce our vega, and we haven't affected our delta very much. So if we wanted to neutralize, we might need to go a lot further, maybe to 8 of them. Now this 1 delta has multiplied into an 8 delta adjustment. That might be more delta than we want. And so we might have to compensate for that with something that will give me little vega, but negative delta to get this back to 36 where we are, because that's the whole idea here is we're trying to do this without changing our delta. But before I do that, yes, it's true, this costs you $18.90. That's per lot, so it's 8 times 1,890 or $16,000 or something to do it. But it's true also that Thinkorswim doesn't change your margin calculation based on that because you've got an option further out in time. If you look at your net, your real margin effect on this, it was 59,500, and with this, it changes, it goes up by the amount of what you're buying, and see how it's not flat anymore, it's slightly negative. So this is something you do have to watch even though this margin number doesn't change. You will have to watch this in your trade if you do this. On the top side, you also have to watch your expiration line when you do calendars, I've learned, because it's not flat anymore either. And you can see that without the calendar it was flat and it was above zero by $500. Now it's greatly above zero in this area, but at some point it goes below zero, and so now you have made an adjustment that's going to make you manage this trade to the upside, just like if you had sold call credit spreads or done some of the other adjustments you can do on the upside. Whoop, got some noise here. Let me mute people. Somebody's unmuted. Okay, I think we're good now. There we go. Okay. What does the, Peter, thank you, good question. What does the Vega graph look like for the combined position? Well, let's go take a look. That's a really good thing to look at. So here's the combined graph. Now we still have downward sloping Vega to the downside, but it should be far less than it was. So let's say, let's just pick a point, 2680. This is projecting a minus 1100 Vega. With the calendars, it's projecting minus 151. That's a much more manageable Vega effect to the downside than 1,000 would be. And it'll affect your P&L favorably if we had a drop to that. So we haven't gotten to the point where we have a positive sloping line. To do that, it would take a whole lot more calendars. 20 of them just starts to level out. I mean, you wouldn't do this, but 40 of them, you know, it's pretty flat and then starts to cover up. If you did 100 of them, just an extreme example, pretty flat. So this would, you know, but you wouldn't do this. I mean, 100 of these, that'd be $189,000 to add to the trade. So we're not going to do that. Back to my example. Let's see. I think how many did I have? I had 8 of them. I think I had 8 of them. Yeah. Well, the only way with a calendar to now neutralize delta is you're going to have to go back and forth and find some combination of some negative delta trade that will get your delta back to 36 where we started from without affecting your Vega for much. And one thing that comes to mind is call credit spreads. So let's say we go back to August, and we go up to maybe 13 delta. Oops, not there yet, sorry. We start selling call credit spreads with a short at 13 delta that are, let's say, 10 wide. Sell vertical and make it a 10 wide. You get some decent credit for it, and it has -2 delta per lot. All right, which means we need maybe 4 of them to get our delta back to where we started from. But now we have lost some of our Vega hedge. You know, it was pretty much -30, and these added some negative Vega, and we don't want negative Vega. We're trying to neutralize it. So if you do it this way, you have to play with the lot sizes until you find something that seems to work. And this has our delta, but now we've got positive Vega, and that's further than we wanted to go. So we'll go to here. We've pretty much neutralized the Vega without affecting our delta much. So this is a combination that might actually work. Now this margin number is not changed. That's good, but we have tilted our wings, and so as I said before, you need to watch that and manage it to the upside. Okay, so here's another way using calendars and call credit spreads that you could accomplish the goal. Now I want to point out one more thing, and then I'll get to the question here. There's a couple more things I need to talk about here. If we uncheck everything and look at just the calendar that we're adding, it looks like this. Now, break even on its expiration graph, we're currently at 27.96. And that can change over time, but that's where it is right now. And it has a lot of theta, which is cool because not only have we neutralized our Vega and our delta, but we have added a lot of theta, which is good. That'll help you on your P&L within where we are. Calendar trade itself on expiration currently in this volatility environment, and this will change as well. Calendars are tricky because this peak of the graph goes up and down as well as the width's getting wider or shorter. It's one of the reasons I don't trade calendars generally, because you got more moving parts. But the peak of the graph is $24,581. I mean, if that happened, we'd be happy campers. And if I put those 3 back in, sorry, what was the price where it did that peak of the graph? 27.20. If it went there and stayed there by expiration, this whole thing would still make $25,000. That'd be cool. But that's way over our profit target for this, and it might not be something you'd want to go for, but it's possible. And here's another thing to think about with calendars. And let's take out those singles because we're not going to look at those anymore. Let's say you did this or wanted to do this. Now calendars, think back to some of the golden rules of options trading that I've presented in here before. One of them is you want to sell extrinsic and buy intrinsic. That's a golden rule. But another one is you want to sell high volatility and buy low volatility. And you can measure that by the implied volatility of the options that you're buying and selling. And Thinkorswim shows it to us right here in this vol column. So we're selling 12.89% and we're buying 13.58%. This is called the skew in a calendar, and if you take the front month minus the back month, that should be positive to give you a statistical edge in calendar trading. It's not positive in this example. It's 0.6. This is about 0.7. It's negative 0.7 here. So this might not be the best strike to choose if you were going to do a calendar like this, because you have a negative statistical edge, or whatever you want to call it. There's a negative skew here to this particular calendar at the current time. And it's hard to do with indexes, by the way. But so what if we change the strikes and we go down to, let's say, 2675 instead for our calendar? Well, now the skew is 0.37, okay? So you can see that what's happening is the lower we go, the more closer we're getting to positive skew. Let's go down to 2600. Now there's actually a positive skew by about 0.15, 0.18, something like that. 0.16, I guess it's 0.16, okay? Well, maybe that's the one to do. But now if you look at just the calendar trade, we have less room to the break even of the tent. So what it means is there's a trade-off here between getting that positive skew or a lower strike and the point at which this calendar is going to start hurting you if the market goes up, and even the delta numbers and everything. If we did this one, you can see we've gone a little bit too far on our vega and too far on our delta. So if we did that, we would need to start adjusting things so that we get the numbers we want. And you can see you have to play with it a little bit if you do it this way. Let's see, too far. I can't easily go from it's going to be hard to do to the point where it might not be possible this way, not easily possible. If we get my delta right, then my vega's all wacky, and so if we say, well, that's too much positive vega, we'll take out some of these. My delta, now we're getting closer, but look at how many of these calls I had to do, and I had to do debit spreads, not credit spreads. I don't think you would actually do this. So it's always everything we do in options trading is always a trade-off. If we're trying to balance all the Greeks with the skew, with the price you pay and all this stuff, it can get difficult. Well, if I was doing this, I would lean towards, this is just from an insight or experiential point of view, I would lean towards having the tent be a bit above where we are, and I might not be quite so concerned about skew if it wasn't too bad. That means a higher strike would probably work. And look at 2650. This might be a good compromise. Okay, the skew isn't bad, it's 0.22. Remember, you're doing this as a hedge, not as its own trade, so the skew isn't really what you're trying to do here. You're doing this to get your hedge right. And with that, let's see if we can find something that works. We might not need very many calendars. Put that in there. Have to play with it. Maybe about 2 of them. I don't know. This is where you have to play with the trade-off. Now, I would also comment, I was trying to keep my delta where it was. However, I might feel like that's too much positive delta, so I might be trying to adjust my delta to be 0 or a bit negative at the same time. And if that was the goal, then could probably reach it easier. Those calendars make it hard. something like this. Maybe the 26, 25. You have to play with everything to get it to work. So now here's something that might work. Now that's a lot of calendars for a 20 lot trade, but here's something that might work. Skew isn't bad, it's practically zero. And that's a possibility as long as everything else, like your margin, is under control and you know how you're going to manage this trade. That's basically as far as I wanted to go here, but let's see, Nathan's question. Would you be looking to add them in a market crash? I would not. Not after the crash has happened. Just like long puts and other things, this is the kind of thing that I'd want to have on before the big move happened. After it happens, volatilities are elevated, prices are elevated. Probably the best thing I can think of at that point is these put debit spreads, because they tend to mitigate the effect of the elevated volatility, and yet they give you the negative delta that you want to hedge your position on the downside. Once it's happened, you're pretty much limited to those debit spreads. In a big market move, you lose money on the calendars. That's actually not true. A big down move anyway, that's actually not true. These calendars would actually make money on the down move. And I can show you that because if we go look at this trade as it stands, my real trade, what was this one? Oh, it's this one, sorry. Here's this trade as it actually stands, and you can see that I did 3 calendars, and at the same time I sold these calls, credit spreads, and that was to do exactly what I showed you how to do here to get my numbers where I wanted them to be. My goal was to cut the vega in half. I wasn't trying to eliminate it. I think that eliminating it might be going a little bit too far. But here's the point. If we just look at this calendar trade, now remember I said that when I opened this trade, the market was at 27.84. I guess I didn't say that, but that's where it was. So it was here when I opened this trade, when I put that calendar on. I paid $11.50 for them, and now these calendars alone have gone up by $1,000 in the drop down to 27.16. And if you uncheck this, you can see that they're quoting at 14.80. So I've got profit in these calendars. Okay, so hopefully that answers your question about move to the downside. Move to the upside, yeah, you're going to lose on the calendars, which is why you have to manage them to the upside before you lose too much on them and reduce your profit potential too much. How to do that is still something I'm doing backtesting on, so I don't have an answer. I just know that at this point I'm looking at the break even on the calendar graph. Which is currently 27.82, but before we get that far, it's going to decrease, I'm sure. So somewhere in the 27, 40, 50 range is probably where I'll start taking these calendars off. I'll probably do it one lot at a time until I complete my back testing and come up with some better rules. That's kind of what my plan is right now. Okay. Plus, you can also note that this calendar's made $991, but the whole trade has only made $569. So if I had not had this calendar and these spreads on, I'd be down $1,000 on this trade right now. The calendars, at least in this move from 27.84 to 27.16, have made a big difference in my trades. One last point. Since vega of an option must go to 0 by expiration, because there's no time left for there to be any variability or volatility on the option, so vega is 0, then it has a steadily decreasing value over time. And this is not something that I think Thinkorswim can show you. The Vega graph simply shows you as of whatever date you have here. I guess we could go forward in time. And if I go up to 2 days before expiration, you have what looks like a very weird graph, but by expiration it must go to 0. It's supposed to go to 0. I'm not sure the model is working right, or I'm not sure why it's saying that, but so I don't typically try to do that in Thinkorswim, but what I might look at is if I just run the thing forward, we've got increasing Vega here. At some point, it starts to get lower. Now what that means is, at some point, having those calendars as a Vega hedge isn't necessary anymore. Your Vega might only be 200 by itself without the calendars. So my plan is to peel them off at that point as well before my Vega gets too low. So I have two things I have to do. I have to peel them off at the appropriate time frame, and I have to peel them off as the market goes up. And just exactly the way to do that, and it's still to be determined. Okay, but also note they make a huge difference on the profitability. On August 9th, at this current price point, we'd have 16,000 in this trade, and without the calendars, we'd have 15, 14 something. So they can be a very useful tool to manage your Vega risk on this trade or any other kind of trade that you're doing. And I think people don't think about it too often. Let's see, Craig, if you use steps, that's an idea. So put this on the Vega thing and use steps. Well, let us do that. Oh, day step. And increase the day step. It's still going to show us the same graph. And Peter points out the long still has Vega, and that's true. That I forgot that, but that's true. The September one still has Vega, so the graph won't go flat to 0. But the graph of just the short part of the calendar will go to 0 by expiration. That's true. Okay. Let's clean this back up. Well, that's what I wanted to say about all this. It's interesting to note that in early February, when we had the huge drop in the market, it was the Vega that hurt everybody that I know of that was in this trade, to the point of max loss or beyond. It does make a difference. Had you hedged your Vega, could you have not been hurt so bad? Yes. I did backtest that, but it still was painful, even if I had hedged all my Vega off. So there's no golden egg answer to this, but you can see how some form of Vega hedging can make it less painful. Okay. Well, that's it. I hadn't thought of anything else to talk about today. Does anybody have any questions or comments or things that you want to, topics you want to bring up? We have 12 people in here. Yeah. I think this was a good one today because I talked a little bit about fundamental knowledge, about how Thinkorswim can be used as, good to know all the things Thinkorswim can do for you, as well as possibilities for hedging off some of your Vega risk in your trades. So I think this was good. Well, then I will stop here. We're just about done, and we'll move on. And we're planning to do all these from Aeromir in the future, but it's still not quite set up right, at least for me, to do them all from Aeromir. I have trouble getting logged in and getting my permissions right if I do it from Aeromir, and Tom's working on that. But at some point, we'll be doing this all the time from Aeromir and not from capitaldiscussions.com. So just so you know. And thanks for joining, and we'll talk to you guys next week.